Broadcom's Q2 Fiscal 2026 report is a definitive statement of market dominance. Total revenue hit a historic $22.2 billion, surging 48% year-over-year. This massive print was driven by two distinct engines. Semiconductor Solutions delivering $15.0 billion, up a staggering 79%, and Infrastructure Software contributing $7.2 billion. Anchoring this profitability is a $15.4 billion gross profit, a 69% margin, up 2 full points. This flows straight to the bottom line. Operating income hit $10.8 billion at a 49% margin, expanding an incredible 10 points. Net income settled at $9.3 billion with a 42% margin, and non-GAAP EPS reached $2.44, confidently beating estimates. Every metric here is a record. Broadcom is compounding at absolute scale. How did they build this dual-engine powerhouse? The answer lies in a highly calculated structural shift. Infrastructure Software is compounding at 40.1% following the $69.0 billion VMware acquisition. But pay close attention to the Semiconductor Solutions segment. It is compounding at 24.6%, reaching $15.0 billion this quarter. This isn't just organic growth. It's an explosion in custom AI silicon. Broadcom isn't selling generic chips. They are co-designing specialized accelerators like Google's TPUs and Meta's MTIA directly with hyperscalers. By locking in these massive, multi-year volume commitments, they eliminate inventory risk. That is how they transform ferocious AI demand into one of the highest margin platforms in tech. The target is clear: over $100.0 billion in projected AI revenue by 2027. This is powered by the AI, XPU, and AMP infrastructure engine, tailoring custom ASICs directly with hyperscalers, unifying workloads via VCF 9.1, and deploying a $35.0 billion alliance for 20 gigawatts of power. This engine drives four massive financial pillars. Pillar 1, the AI engine. AI semiconductors surged 143% to $10.8 billion. With bookings exceeding $30 billion, demand for custom silicon is massively outpacing current supply. Pillar 2, the cyclical foundation. Non-AI semiconductors and networking hit $4.2 billion. Bookings topped $6 billion, confirming the inventory correction is over and a new upcycle has begun. Pillar 3, the defender. Infrastructure Software generated $7.2 billion, maintaining a staggering 93% gross margin. VMware's subscription transition is driving a 17% growth in annual recurring revenue. Pillar 4, the cash cow. Broadcom generated $10.262 billion in free cash flow, up 60% year-over-year, converting nearly half of every revenue dollar into cash. This is not just profitability. It is a financial fortress. To truly grasp this megatrend, observe the internal mix shift within the hardware division. In Q1 fiscal 2023, AI represented a mere 12% of Semiconductor Solutions. By Q2 fiscal 2026, it dominates the portfolio at 72%, generating $10.8 billion. Crucially, this AI surge does not come at the expense of the traditional business. Non-AI revenue actually grew 6% to $4.2 billion. Broadband, industrial networking, and server storage are providing a rock-solid, cyclical foundation. In just 3 short years, AI went from a promising footnote to the absolute core of Broadcom's hardware empire. Wall Street isn't just buying current earnings. They're buying Broadcom's 2026 to 2030 monopoly blueprint. Let's break down these 4 strategic pillars. First, the $100.0 billion roadmap. Broadcom has successfully locked in 6 strategic hyperscalers with long-term supply commitments. But the absolute crown jewel is the 10-gigawatt infrastructure contract with OpenAI. By delivering custom ASICs and Tomahawk switches straight through 2029, they have essentially guaranteed their long-term revenue pipeline. Second, the connectivity war. Broadcom's Ethernet architecture is actively defeating NVIDIA's InfiniBand on cost efficiency for cloud giants like AWS and Oracle. With Tomahawk 6 delivering an unprecedented 102.4 terabits per second, they own the network backbone. Furthermore, their co-packaged optics technology pushes physical limits, slashing power consumption by 3.5 times and reducing optical cost per bit by 40%. Third, the software cache machine. VMware Cloud Foundation has already hit an 87% adoption rate among top enterprise customers, defending a 93% gross margin. More importantly, as geopolitical friction drives nations to build secure, localized AI clouds, Broadcom is perfectly positioned to capture the new $5.0 billion sovereign AI market. Finally, infrastructure and risk control. AI's biggest bottleneck today is electricity. Broadcom bypassed this by partnering with Apollo and Blackstone, deploying $35.0 billion to build 20 gigawatts of dedicated AI power. Simultaneously, they are actively de-risking their supply chain away from China by leveraging the U.S. CHIPS Act. And with a massive 46% free cash flow margin, they are funding this entire global takeover without straining their balance sheet. Scaling operations requires ruthless financial discipline. Following the initial integration costs from VMware, Broadcom's total operating expenses stabilized at $4.6 billion. Notice the strategic allocation. They are heavily funding the future, increasing research and development by 11.5% to $3.0 billion. At the exact same time, selling, general, and administrative expenses actually decreased by 1.9% to just $1.1 billion. The strategy is crystal clear: maximize core engineering while aggressively cutting corporate bloat. This gap between 48% revenue growth and flat costs is pure operating leverage. This exact discipline dictates the net income trajectory. The massive VMware acquisition temporarily inverted net income margins to a negative 14% at the trough in late fiscal 2024. However, the subsequent restructuring was a masterclass in corporate efficiency. Margins fiercely rebounded, climbing to 31%, peaking at 47%, and officially locking in at a highly robust 42% in Q2 fiscal 2026. This translates to a staggering $9.3 billion in pure profit. The integration pain was temporary, but the profit scale is permanent. Institutional trust is built on flawless execution. Broadcom consistently beats consensus estimates, posting $22.2 billion this quarter against a $22.1 billion target. Looking at the latest market updates and analyst models, the forward consensus anticipates an aggressive climb toward $39.2 billion by Q2 fiscal 2027. Based on recent institutional reports, major banks like BNP Paribas and JP Morgan have strongly upgraded their outlooks, anticipating that Broadcom's massive $30.0 billion booking backlog will easily shatter these upcoming estimates. The non-GAAP EPS story confirms this systematic outperformance, reporting $2.44 against a $2.40 estimate. The trajectory steepens dramatically. The latest Wall Street consensus projects EPS to cross $4.44 by mid-2027. Despite these massive growth figures, recent financial data reveals Broadcom is trading at a highly attractive price-to-earnings-to-growth ratio of just 0.63. This implies that relative to its explosive earnings growth, the stock remains fundamentally undervalued on the open market. So why did the stock experience a 15% after-hours pullback? It was a classic valuation reset in a market priced for absolute perfection. Investors reacted to a slight Q3 AI guidance, whisper miss, and the CEO's refusal to aggressively hike the 2027 targets. But the broader market reality tells a different story. Trading near $395, the stock offers a massive discount to the $509.20 average price target, with maximum estimates reaching $640. Based on 55 analysts, 42 rated a strong buy and absolutely zero recommend selling. A company generating over $10.0 billion in quarterly free cash flow, holding a $30.0 billion AI backlog, and dominating the infrastructure landscape, does not lose its thesis over conservative guidance. The speculative froth is gone, and the absolute fundamentals remain intact. As always, this analysis is for informational purposes only and does not constitute investment advice. Please consult a qualified financial professional before making any investment decisions. Thank you for watching. If this deep dive provided value, please hit like, subscribe, and share. It helps more investors access quality, data-driven research. See you in the next one.